before I ask my question, I just want to remind you that back in the days of conglomerates, another genius, Harold Janine, ran IT&T before it was broken up. But I mean, there was a time when people really thought this was the greatest thing coming down the pipe with these big conglomerates. My problem is the wealth divide. And it seems to me these Wall Street financiers with their, what I would consider obscene stock options and bonuses, it may be all right to work in your own self-interest, but I don't think that I'm that much less of a person than some of those people are, and I don't have obscene amounts of money. I mean, isn't there a problem in our economy? What is the problem?
Well, yes and no. Let me start with defending stock options, because I think stock options are wonderful. Why were stock options invented? Where did they come from? Because they're relatively, they've always been around, but as we know them today, they're relatively modern phenomena, really of the 1980s, the same 1980s of Mike Milken. And stock options were invented because there was something that became evident during the 60s and 70s in corporate America. And that was that there was a real disconnect. And remember, the whole corporate structure is a relatively modern invention, and people are trying to work through, how does this work? And one of the problems that people realized in this corporate structure is that you hire these managers, and the manager has a certain incentive structure. He wants to, wants to maximize, wants to minimize risk. He wants to make sure that he can keep this job for a long time. Not every manager is motivated, through integrity to really grow the business and make it the best business that he can. A lot of them are motivated by other incentives. And one of the reasons conglomerates were created, because they're really good for managers, right? Conglomerates are low risk, right? One business is sinking, another business might be rising. They're diversified. But shareholders can diversify by buying lots of stock. They don't need a manager to do diversification for them. It's a very expensive way to do diversification through a conglomerate. But the manager has an incentive to do it because he doesn't own any stock. And what they discovered is managers didn't own any stock, particularly in these very large businesses. And if they owned it, it was so tiny, it didn't make any difference. So there was this disconnect between the shareholders' incentives to maximize shareholder wealth, in other words, to maximize long-term profitability of the company, and the manager's incentive, which might have been different. It might have been to lower risk or to maximize his, pension, or to grow a big company so you could go to really nice parties, right? The bigger the company, the better the party. Stock options were invented to eliminate that problem. So basically we said, here, manager, we know, the company's big, and instead of giving you out-and-out stock, here's an option, which basically means if the company does well, i.e. if the stock does well, if we shareholders value the company more and more, you get very handsomely rewarded. And if the company stays flat, you get nothing. Nothing. You don't even get the value of the shares. That's what an option does, right? So here was a tool, a fantastic tool in my view, to align the incentives of managers and shareholders. And by the way, people say options encourage managers to take on a lot of risk. Yeah, they do. But that's exactly what shareholders want managers to do. Because shareholders tend to be diversified. They want their managers to take on risk because they can afford any particular company getting into trouble, because most investors are pretty well diversified. So we want them to take on risk. Stock options, get them to take on risk. We want to reward them when the stock does well. Stock options allow them to get rewarded when the stock does well. Every case in which a manager made huge amounts of money, so-called obscene amounts of money, from stock options, shareholders made even more money by a factor of 100 than he ever did. So you won't find a case where a manager makes a lot of money from options where shareholders don't benefit as well. Now, there are crooks here and there that people manipulate the system. There always will be, there always are, but that's a small minority of stock options. But let's get to the broader question. So first, people are compensated based on what the market will bid. There's a market for CEO talent, just like there's a market for engineering talent, there's a market for public speaking talent, there's a market for different talents. The fact is that the market for CEO talent has driven prices over the last 50 years very high. Why? Supply and demand. There's a lot of demand, and it's global today, because U.S. managers who are good, there's a global market for their services, for their work, and there's very little demand. There's just not that many people qualified to do the job. It's very, very difficult. I could do a whole lecture on, what it takes to be a CEO and the kind of skills and efforts and the kind of decisions they have to make and the integrations they have to make. And you're right, Jack Welch, or the guy who ran ITT, those are really, really rare phenomena, and they make a lot of money because they're rare. Rare, a diamond's more beautiful than rubies? I don't know, but they're rarer, and we value them more, so they're more expensive. Supply and demand. That's what drives CEOs. Now, given all that, there is a problem. There is a problem of the way wealth is allocated, if you will, in our economy, the way it gets allocated. And I do believe that the difference, for example, between rich and poor in the United States, that difference is more than it should be. Should be by what standard? Should be by the standard of a free market. I think in a free market, it would be reduced. Now, not because the rich would become poorer, but because the poor would become richer. I believe that what hampers and distorts the distribution of wealth and salaries and all the stuff you were talking about is government. Government policies damage the poor, particularly the ambitious poor, the entrepreneurial poor, the smart poor, much more than they damage the middle class or even many of the wealthy. And some government policies, particularly in banking, allocate wealth to banks first. So, for example, when the government prints money, it's printing money, where does that money go? Well, it goes first to the banks, and right now it's going to the banks in a big way. So I can't borrow at zero. Goldman Sachs can. So does Citibank. Citibank can borrow at zero. If you can borrow at zero and you can't make money, something's wrong. So they borrow money, and these banks are making a lot of money. Now, this is a scheme that the government is running in order to save the banks, in order to allow them to get back to profitability because of all the losses they did. Everybody knows this, and this is what they're doing. They bailed out these banks. Now, does that create a distortion in the way wealth is allocated? Absolutely. We all get taxed in order for Citibank to be able to continue to pay salaries. That's wrong. Citibank should have gone bankrupt. Citibank should have been allowed to fail. But whose fault is that? Is the capitalist's fault? No, it's the mixed economy. It's government intervention's fault. It's the fact that we had a Federal Reserve's fault. It's too big to fail's fault. Citibank has gone bankrupt 4 times in the last 4 decades. Latin America debt. And we bailed out. We didn't bail out Citibank directly. What we did is we bailed out Mexico so that Mexico could pay the bonds, could pay back, could pay Citibank for the money Citibank had lent it. So we were bailing out Citibank. We were bailing out Wall Street. Commercial real estate in the early 90s, Citibank was bankrupt in 91. The end of 91, Citibank was bankrupt. They knew it. And basically Greenspan lowered interest rates to the sharpest rate ever, other than this last crisis, in order to save Citibank again. And they went bankrupt twice during this financial crisis. They got bailed out twice. So what kind of culture and mentality do you think that places at Citibank? Well, culture mentality that says, when things are good, we can make as much money as possible, and we get rewarded. When things are bad, we can walk away because the government owns it all. That's not good, but whose fault is that? Is it the financier's fault? No, it's government's fault. It's government's fault for setting up the rules that way. The rules are corrupt. The rules need to be attacked. Too big to fail is horrific for American culture, for the incentives of the banking industry, and it distorts allocation of capital. It distorts the allocation of wealth. It's a distortive parameter. So let's get rid of too big to fail. But you don't get rid of too big to fail by claiming that bankers are immoral and bad guys. And within the structure that we have today, salaries are allocated mostly based on supply and demand, within all the constraints that government place on it. And the fact is that me and you, our skills are not in huge demand. That's just a fact. I think I'm a pretty smart guy. But I'm never going to make as much money as somebody in the financial markets, because the kind of profession that I have is not in high demand out there. People are not willing to pay me the kind of money that they are to a banker. That seems completely reasonable to me. And in any society, even the freest society in the world, when we achieve complete freedom, teachers are going to get paid less than CEOs. It's just, it's just the way, the type of skill that a CEO of a large company has is going to require larger compensation based on the rules of supply and demand than a teacher is. And when you choose a profession, take that into account. Absolutely. Doesn't mean the CEO is more valuable to you as an individual than, money is not a measure of all things. It's a measure of some things. It's not a measure of all things. It doesn't mean they're more moral or that they're a better human being or any of that. It just means that their skill is valued more by the marketplace than my skill. Big deal. I don't take offense by somebody else making more money than me. Quite the contrary, I cheer for them. Good for them. It means that they're producing stuff. Who benefits when other people produce? I do. You do. So I always, the more millionaires, the more billionaires, the better. But there is a distortive effect. Government does distort. There's no question about it. Environmental regulations, all those regulations, who they hurt the most? The workers. The workers, and this is the myth, right? All these regulations are supposed to, they inhibit and they make the lives of CEOs miserable, but they also reduce the wages in our economy.
You've spoken extensively about the detrimental effects of regulation. What, in your opinion, should the role of regulation play with respect to globalization? And in a hypothetically 100% free economy, is there a moral, ethical obligation for companies to keep money in the country?
So I think regulation should play no role in terms of regulation, and no, I think the moral obligation is the reverse. A friend of mine, one of the board members at the Diamond Institute, Harry Binswanger, had a talk called "Buy American is Un-American." It's wrong, morally wrong, for a company to keep its money in the United States because it's the United States. What's good for all of us as Americans, and what's good for the company, and what's good for the shareholders, is for it to do what's good for the shareholders. It's for it to maximize its profitability. And if that means putting the money in China, then it should put the money in China. Globalization is in a truly free market. Granted, there are lots of distortions in the world today, and we still benefit from globalization. But in a truly free market, the benefits of globalization are fantastic. Just think of the simple benefits of trade between two human beings. Economists, again, 300 years ago, figured this out. The division of labor, going back to Adam Smith, division of labor and specialization and trade are win-win activities. Both parties benefit. It's not a zero-sum world. It's a growing pie. Now take that situation of two people, multiply by 100 people. Now it's even better, right? And now make it 100 million people, 300 million people in the United States. Much better. We're all specialized. We're all doing a thing. We're all producing. We're all trading. All of our lives are better. Win-wins all across the board. Now take 300 million and turn it into 6 billion people. Even better. So the best thing you can do is encourage free trade. Encourage no barriers. Encourage more win-win situations. Encourage trading. Trading is win-win. We all benefit from it. So the best thing we can do is globalization. The 19th century Industrial Revolution, to a large extent, was the original globalization. What was the British Empire about? It was about eliminating trade barriers and creating these colonies were there to mine raw materials, to get cheap labor, and then to facilitate trade. Now, granted, they were pretty harsh and they did some ugly things in order to facilitate all this. But the benefits of trade were already realized in the 19th century, with the British Empire. And then we went into a period after the Great Depression where trade was restricted. And we've slowly, after World War II, started growing out of it. And today we live in a world where trade is, relatively free. There's still a lot of barriers up there. But look how much wealth we've created as a consequence. And again, the biggest beneficiaries of freedom are the poor. The biggest beneficiaries of so-called sweatshops are the people in the sweatshops. They're making a living. They're not subsistence farmers anymore. They're learning skills. They're getting self-esteem. They're producing stuff. They're making stuff. Their standard of living is going up. Now, does an American company has a moral responsibility not to enslave people in another country? Yes. If you're producing, if you discover that a subcontractor of yours is producing goods by whipping their employees and chaining them to machines, you should stop doing business with them. But as long as the transactions are voluntary, then people are better off for having those transactions. So you want to encourage trade, you want to encourage globalization.
Free market create a lot of short-term self-interest, like guaranteed bonuses, or even reward for failure, like golden parachutes, and other various devices that we've seen.
So what were the two example golden parachutes, and what was the first one?
Guaranteed bonuses.
Guaranteed bonuses.
Yeah.
I don't believe any of those reward for short-term. I think those are just mechanisms to attract talent. So I'll give you the most famous example of this was the guy who ran Home Depot, Nardelli. Remember Nardelli? He ran Home Depot, and the stock of Home Depot was basically flat, and the comparison was Lowe's, and it went through the roof. So the board ultimately fired Nardelli, and they gave him a golden parachute, right? They gave him a huge bonus at the end. Why? Well, because when they hired him, that was part of the contract. And contract law says that you abide by contract. Now, why was it part of the contract? Well, because when Nardelli was hired, he was the most sought after CEO in America. There was no CEO candidate that was more sought after than Nardelli. So he sat down with, let's say, 5 different companies, and he negotiated with them. And one of the items that he negotiated was the golden parachute. Why did he negotiate about golden parachute? To defend himself against an arbitrary board that just fired him on whim. Why did the board sign it? Because they did what they did is they looked at his total compensation package and said, is this guy worth the salary, the guaranteed bonus, and the golden parachute? And they summed it all up and said, yeah. And you wouldn't be here asking the question if they loaded it all up front and given him a signing bonus. I'll give you an example. The Boston Red Sox, baseball, I know a little bit about baseball, not too much, signed this Japanese pitcher. I can't pronounce his name. Matsuzaka, right? They signed Matsuzaka, and they paid him a signing bonus of $5 million. $50 million, I'm sorry. It was a total package of $100 million, I think. $50 million, and then $50 million over so many years. The guy never pitched in a Major League Baseball game. Is that short-termism? No. It's the Boston Red Sox saying, this guy's so good, we think, that we're willing to take a risk. We're going to pay him all this money, and if we're wrong, we lost $100 million. But if we're right, we're going to win a few World Series, and we're going to make a lot more than $100 million off of this guy. It turns out they were probably wrong. The guy's good, but he's not that good. And they're probably wrong, and the guy's not worth $100 million.
So do you think that that's a good practice?
Absolutely.
Right now?
Absolutely. Again, who's to decide? One of the questions to always ask yourself, so first of all, I don't think it's a short-term practice. I think it's a just risk-return trade-off. Here's a risk. Will he be able to pitch or won't he be able to pitch? What's the return? How much am I willing to put up? It's a net present value analysis that you do in business every single day. It happens to involve lots of zeros, but you could do the same argument paying somebody $500 to paint your home, and you give him something up front and he does a lousy job. But you didn't know he was going to do a lousy job when you gave him the $500 up front. So that's the trade-offs. That's the kind of decision-making you do every single day. Just here, there's a lot of zeros, so we get upset. But it's their money. And that's the key. Every time You see somebody making a lot of money and you get upset, ask yourself, why do I care? Because I don't. Whose money is it? You know, in a free market or even in our relative, it's the shareholders' money. So I ask myself, do I own stock in Home Depot? And if my answer is no, then I say, I don't care. And if the answer is yes, then I say, maybe I should sell. Or maybe I should go to the board meeting and vote differently or yell at the board managers. Or maybe I should talk to other shareholders and we should take over the company. You know, so there are 100 different things that you can do. But if I don't own the stock, then it's none of my business. They're paying for it. The shareholders are. But Nadelli's a great example. Nadelli came out of GE. The GE board was considering 2 candidates to replace Jack Welch. Nadelli and Immelt. Nadelli was considered the Jack Welch-like CEO. He's a hard-nosed, tough, demanding businessman. Immelt was considered the opposite of Jack Welch, the politician. He's a good schmoozer. He knows Washington. He does well at parties. Right? And they had to choose between the two. And when they chose Immelt, it was clear the path GM was going to go, suck up to government, which is what they've done, of course. And Immelt is an awful CEO in running the business and very good in Washington. And now Nadelli was let loose in a sense. He left GE because he didn't get the job. And then everybody wanted him. So then it's just a negotiation. Now, you could argue about whether he did really badly or not at Walmart, at Home Depot. He didn't do well, but he didn't do awful, it turns out. But that's irrelevant, you know, so they fired him. And he got whatever he was promised to get. And guess who hired him? The private equity guys hired him, and they put him as CEO of Chrysler. And you know what? Looks like he didn't do a great job there either. So maybe there's a lesson to be learned there about Nadelli. But they all thought he was a good guy. And we're not talking about dumb people thinking he's a good CEO. We're talking about some of the smartest people around thinking he's a good CEO. So ex ante, they made a mistake. Haven't you ever bought a stock and then regretted it? It's the same thing. You invest in a CEO and then regret it. But it's not short-termism at all.
This is the last question.
Last question. Sorry, guys.
Thank you.
So make it good.
I'm confused by the actions of Warren Buffett. On one hand, his legacy or his career, he's considered, and I consider him to be a great capitalist and financier. And on the other hand, he's come out in the last year or two and made a lot of defenses of government intervention. And I'm just wondering what your thoughts are, if you think that that's a reflection of the changing rules or whether there's something else going on.
No, Warren Buffett, you know, yeah, he is, it's hard to imagine the state of mind that a person like that has to be in. On the one hand, benefit enormously from the freedom we have in the marketplace and attack it at the same time. And it's not in the last few years. You can track this back at least a decade or two. Warren Buffett is the illustration of the importance of philosophy and ideas. Warren Buffett is an intellectual. He is very, very, very smart. And you can see that in his investing. But he has chosen to adapt a philosophy that's antagonistic to the capitalist system in which he made his wealth. And so he interprets the way he made his wealth in a way that I don't think any of us interpret. So his interpretation, and this is philosophical, and he really believes this. I'm not kidding when I say this. He believes he made his wealth because he's lucky. Now, how does that luck manifest itself? He's lucky because he was born in the 20th century. He's lucky because he got the genes that he got. He's lucky because he had the parents that he had. He's lucky because he was at the right place at the right time for all of these deals. He's lucky because he met, what's his name, Munger, you know, his partner who's really, really smart. All of those he considers luck. And he considers those determining factors in his success. He, Warren Buffett, however you conceive of that, played no role in his success. It's all these external and genetic things and the fact that he was born, when he was born, that led to his success. Now, where does he get that from? Because that's pretty intellectual, it's pretty sophisticated, and pretty nuts in my view. He gets it from a specific philosopher who taught at Harvard and who died just a few years ago. He got it from John Rawls. And John Rawls is one of the most influential philosophers of the 20th century. And he advocated for the idea that Everything in our lives is a product of luck. It's a product of our genes or of our environment. And indeed, most debates are like, are you a product of your genes or are you a product of your environment? Well, if you're a product of either one of them, it's all luck. I argue that, yeah, both of those play a role, but you're a product of you, of the choices you make. We believe in free will. Warren Buffett, in a very, very fundamental sense, doesn't believe in free will. And if you look at Rawls's language, Buffett speaks it, almost verbatim. Ayn Rand wrote an essay on John Rawls in the 1960s. She picked it up, and she saw the danger and the evil in his philosophy. He's an egalitarian. He's about equality of outcome. And if you want to advance, if you want to be better, that's okay only if everybody else is also better off. Nobody can go backwards if you go forwards. That's the kind of world. And, his philosophy is interesting and complex and really, really wrong and evil. But Warren Buffett buys into it completely. And what's interesting is if you watch Bill Gates from when he was younger and you watch him, you can see a change in the language and the way Bill Gates talks about himself that starts when he first meets Warren Buffett. They play bridge together and they're really good friends. Warren Buffett has had a profound influence on Bill Gates in terms of his thinking. And Bill Gates is now also John Rawls' student, directly getting it from Bill Gates. This is the power of ideas. It's about philosophy. It's not about experience. It's not about what you do in life. It's what you think that is going to shape what you hold and how you do it. So, and in that sense, Warren Buffett is compartmentalized. He acts to be a capitalist and make lots of money because he has no choice. His genes and environment has dictated that, right? And he holds these ideas, and the contradiction between the two doesn't bother him one iota because it's all deterministic. In a sense, it doesn't matter. And people can be compartmentalized. They can hold opposite views of different parts at the same time. But that's the importance of ideas. That's why it's so important to understand fundamental ideas and to talk about fundamental ideas and to challenge fundamental ideas. It's why people like John Rawls and Ayn Rand and Karl Popper and Immanuel Kant and Aristotle are the ones who really change the world. And these politicians are, they're a dime a dozen and they come in and out. And even the more notorious ones, they are just products of these philosophers who really impact the world. And it's all about ideas, ideas, ideas. Thank you all.